use other people's money. And I want to start this with a case study. These are two more of my Circle of Champion members, Dennon Williams and Terry Warren. They're partners. They live in the Carolinas. And when I met them, they each had 0 prior real estate experience other than owning their own home. And they both had this in common. They both have been laid off. They've been with the company for 25 years, and they've been laid off. And when I met them, they wanted to get started buying and acquiring real estate. And here's the problem. They were unbankable because they had no W-2. Banks aren't going to loan money to somebody that doesn't have a W-2 because they want to see that W-2 income. Well, what they did over the next 10 months is they actually did 4 deals, 4 major deals, purchased property, and funded $6 million of those transactions, those multifamily transactions, 100% using other people's money. They used none of their own cash in any one of those 4 deals. They had no credit check in any one of those deals, and they had no prior experience. So you look at this. How is that even possible? How could anyone possibly purchase $6 million in real estate with none of their own cash, none of their own credit, and they had no prior experience? How can you possibly do that? Well, there is a formula. There's a formula. I'm going to share with you the same formula that I taught them. This is how you're going to get your leverage, these other people's money, by being able to raise private money. So this is the raising private money formula, and I'm just going to give you the formula real quick. I'm not going to be delving deep into this. That's not the purpose of this training, but I want you to know this 4-part formula, because this is how you can fund anything from $6,000 to $6 million, whether you need rehab money, down payment money, acquisition money, earnest money, any money that you need for your deal is through this formula. So raising private money formula, there's 4 parts: predisposed, control, low risk, high return. Predisposed, control, low risk, and high return. All right, what do I mean by that? Well, predisposed means when we go out to raise money for our projects, we're only going to focus on predisposed investors, people or groups that are looking to invest in real estate deals. They believe in real estate as an asset class, and they're ready to invest their money in real estate, but they're looking for the proper deal. All right, predisposed groups. Now, I've already told you one of the predisposed groups up front. Self-directed IRA investors. Self-directed IRA investors, one of those predisposed groups. Here's another one. Sellers when getting owner financing. There's another predisposed group. That's just 2 of many more that we teach, but those 2 right there get you started. All right, once we have an investor, how do we attract them to our deal? Well, that's what the rest of the private money formula is about, to how to structure our deal to make it attractive. When we structure our deal, we have to do it in a way that provides that investor a feeling of control and a feeling of low risk. Because the number one question, the top of mind question by any private investor is this: tell me about return of my capital before you tell me about return on my capital. Which means they need to be confident they're going to at least get their principal back before they even listen to any claims about what a great project this is. So we address that question about preservation of capital by giving them a feeling of control. We intentionally structure the deal so they feel like if something goes wrong in the project, they can take control and get their money back out. That's paramount. And then next what we do is we structure the deal to show them how we've created a low-risk investment, how we've mitigated the risk strategies and created a low-risk investment. So now they're feeling comfortable that, yes, indeed, there will be a way for them to get their money out of the deal. Then the final thing we do when we structure our deal is we structure it in a way to give that investor the feeling of a high return. But here's the key part. It's high return relative, underscore that word, relative to the low risk that we've built in. We spend a lot of time structuring and demonstrating to that private investor how it's a low-risk investment. As a low-risk investment, the investor's expectation of return is low, but we're going to give him a high return relative to that low-risk expectation. And when you do that, you are basically answering that top-of-mind question about preservation of capital, and you're letting them see that they're getting a deal, by giving them a high return relative to that low risk. And that's the four-part formula. Now, what we do not do is go out and just advertise waving some big high return, absolute return to private investors and just scare them away. And that's what most amateurs are doing, and that's why they can never fund any deals. You follow this formula. This is the exact same formula that Denon and Terry used to fund $6 million across 4 transactions over 10 months, using none of their own cash, none of their own credit, and they had no prior experience.